Fed balance sheet is in right after market close. Not helpful, but it is down again, trying to crack 7 trillion. So Fed is not doing anything. They are decreasing the money supply. Let's take a look at the Treasury. And this is the Fed website, Federal Reserve of St. Louis. And so I just zoomed in on the last few weeks here. So this is the whole balance sheet. And I'm just, and this is really funny. They painted a little recession for like a week. we're out of there, all clear. um, but yeah, it's about a straight month of no balance sheet expansion. We had a slight increase, and now it's reversed back down. So yeah, yep. And here's the Treasury General account, the TGA. This is the checking account for the Treasury for Congress. So this I call the helicopter general account because this is spending money that they can spend right into the economy, and this is inflationary money that can be, used in the domestic U.S. economy for normal goods and services, as opposed to, the Fed. Well, if the Fed expands their balance sheet, they're buying assets, buying treasuries. That money goes on to, as bank reserves, has to go through the whole financial system. But the Treasury General account, they can spend that right into individual or companies, spending accounts directly. But anyway, this is decreasing a little bit. It's still going up. So this looks like it's starting to level off a bit. So this is something to watch. If this thing starts coming down, that is inflationary helicopter money into the economy. They probably shouldn't be able to spend this in without announcing some big bill that they're going to use it for, but they could. So definitely something to watch. It's still going up, and going up is taking, this is where taxes go, or this is where the Fed money goes if the Fed gives them money. So this is taking liquidity out of the economy as well because it's still going up. So the Fed's going down. That's taking liquidity out, and this one going up is taking liquidity out because they haven't spent it in yet. And I don't know if I showed you guys this one before. This is the Chicago PMI, and so this is a purchasing managers index to see how industry's going, and it did come up a little bit from 32 to 36, but in the 30s is recession territory here for the purchasing managers. And then the job numbers, I covered that in the last video, but Trump is saying that we're roaring back because it was 4.8 million jobs added. Yeah, it's supposed to be 2.8. Yeah, so the official unemployment rate is down to like 11% or something like that, but the actual number of people not working is still more than 50% of Americans. And this is a worldwide, this is the biggest unemployment hit in the entire history of the world. So, not that exciting, but better than expected. And then as far as the liquidity goes, it's back here where the Fed stopped pumping liquidity, and the Treasury has continued to take liquidity out this whole time here. So this whole choppy sideways stuff is all tight liquidity. It's not really going down, it's just kind of going sideways. And so that's kind of where we painted here, where we closed. And so this looks a little bit more bearish now to me, because every time that we have kind of bumped and reversed off of this line, we've crossed this whole zone It's like 4 times now. We just keep crossing back and forth this expanding zone and didn't break out and then closed down here. So it's not down low enough. I drew a little kind of support line here just to show this is not trading advice, but just to kind of show where if it breaks down here, then that would set up a short trade. But it's not low enough for that yet, and we won't see it till Monday because the markets are closed tomorrow. But for bullish, you want to get up out of here a little bit before you go for a bullish trade, and then this is, I don't know. The Fed's not pumping liquidity. This thing didn't make it up. This looks bearish enough for a bearish trade here. Well, whatever. It'll be Monday, so who knows what it'll do. So yeah, 3-day weekend, we could get a gap one way or the other to open, which could be pretty interesting. And then the other stuff is pretty normal. Like the dollar is on a super, it's on like a 10-year pretty calm kind of bull run, and the dollar is on support for like, this is like kind of the support line over like 10 years that the dollar's on. So to me, it looks like the dollar's going to keep going up a bit. It looks like liquidity is still tight. The Fed's not pumping. As far as the Qs go, the Qs loved the announcement that the Fed is going to buy like Apple and Microsoft bonds, which was a huge surprise. I thought they were going to try to buy financial bonds for financial liquidity purposes or something like that, but they just came out with this sheet of all kinds of auto and infotech, and like Blizzard Entertainment was on there. Berkshire Hathaway Energy was on there. Like, what in the world? Apple and Berkshire, they don't need cash. That's two of the biggest cash piles ever. Those two. So I mean, their bond purchasing sheet was absurd, like just absolutely absurd, and it wasn't backstopping the banks. They're just really just buying whoever they feel like it, and and it looks good for the Qs and the Nasdaq because they're going to be be buying the bonds like Microsoft and Apple and stuff like that. And so I guess that is just a general way to get liquidity into the market. And those are bonds that aren't really at risk. Like most of the stuff the Fed takes onto the balance sheet is absolute garbage that they're going to have to hold, and it'll just stay there forever. But these ones like Apple and Microsoft, like those ones will get paid back and they'll come back off the balance sheet. So that might just be a way to get liquidity out, a little bit of liquidity from a company that is actually going to stay in business and pay them back. And then let's check out how the Russell closed out. So the small caps did a little bit of a run here, but not as strong as the Qs. I don't know what these lines are all about. Closed down a little bit weak. So yeah, not much to go off of. But the financials have just been kind of blah. This whole time the liquidity has been tight. Is this whole section here? This is all the tight liquidity and the low interest rates. Interest rates are trading low again. The liquidity is tight, and financials don't like that. So that, the kind of the fundamentals and the liquidity and all of that looks pretty bearish. The bond buying in the infotech sector. So infotech is having bonds purchased now for no reason, and also they're still doing stock buybacks. So this has been a really strong sector, and for the liquidity coming into the market, this is where it's been going for the most part. So right now is a big split. Like the differential between like the Qs and the financials, or the Qs and the general stock market, is pretty big. So the infotech sector is just way above everything else, which that could be a signal. I mean, at some point that'll reverse, but it doesn't mean that it's going to happen now. And then, oh, did gold break out? Gold was set up to do a little breakout move, and I'm not a huge fan of a gold breakout when the liquidity is super tight. Like, I want to see like the helicopter account go into the economy. Then I'll jump into like gold and silver. Right now, if they're tightening stuff down, this breakout seems kind of suspicious, but it looks like it's doing okay for gold. I think silver dropped back in. Yeah, the silver kind of didn't break out. It didn't really make it. So silver definitely, like, you want high inflation for silver. Like, it needs to be growth and inflation at the same time. And we don't, I mean, I suppose this is growth relative to the last quarter. It looks like it might be. And so if the Treasury general account starts flowing into the economy, that's when I would start looking at gold and silver from the kind of liquidity fundamental standpoint. As for right now, I think they're both still just kind of chopping sideways, but they're definitely interesting to look at. And Bitcoin kind of finished down with the stock market. It keeps making moves that the stock market's doing, which is pretty interesting. And Bitcoin, let me go out a little bit. Bitcoin has kind of broken down out of its pattern it was doing here. It's starting to turn over. I don't really like this chart very much. And sort of on the long term, it's kind of in this zone here. And I just adjusted this one around to where it is now because I had it down tighter before, but it seems like it's kind of breaking down out of this wedge. It didn't pop up. I don't like the Bitcoin chart very much right now. And I mean, to the upside, I don't know, like more chop sideways, I guess would be good. And we have a long-term moving average pretty close by. So that's pretty good support, not too far away. But the bottom edge of this zone is a long way. And people are going to be freaking out if it gets down to like 6,000 for sure. Um, yeah, careful, careful with Bitcoin. And I don't know if, I mean, like the liquidity fundamental stuff for Bitcoin is just crazy complicated because it's not like, I mean, I guess the same stuff that's good for silver would be good for Bitcoin. You want inflation. I don't know if growth really matters. I think you just want people just freaking out about dollars, which would be good for all of the other monetary assets. But yeah, as for now, the dollar's kind of getting stronger. There's not a bunch of inflation or liquidity this week, this month. So those don't look great. So there's still not a lot of things where all the things line up where it makes sense to do anything. We're just kind of waving around in the middle of nowhere still. And I'll take a look at the longer term thing. So we have this bull market support line here that came off that 2018 bottom, and that's what we're underneath right now on the S&P. And then we have this 12-year bull market line that supported the bull market all the way from the bottom of the 2008 crash. And so we're above that. We're underneath the 2-year long line, the Volmageddon line. We're above the financial crisis line. I have some labels here. Yeah, and we're just right in the middle of this zone where we've been chopping around, and we're just still in there. And so it looks like we rejected off the top again. And you can see on these candles, what are we on? Dailies? Yeah. This is good. Check out the dailies. But you can see that you got these wick kind of reversal candles every time we made it up into here so far, and we did it again today. And so that doesn't look like it wants to go up right now. But we'll see. We'll see what we get on Monday. This could go either way, but I think if it breaks, I think if it breaks across this green line down, it's probably headed back down to this area. And so down here we have all kinds of good stuff. I mean, we have this consolidation zone crossing these two major support lines. So It'd be pretty easy to bounce right back across. It wouldn't be surprising at all. This is major support. So, I mean, it has to break three. I mean, this downtrend is not major, but this moving average is major. This is kind of the bull bear cross, and we're on the bull market side of the line right now. And so breaking down here would be a big deal. And then definitely breaking down under the 12-year bull market support line. If we broke down here, that would be very bearish. So those are just kind of the targets here. I mean, we're just chopping around. We're chopping around in here, going crazy. Still have high volatility. And, the bulls want to get up out of here. You want to get above this support line, and then you could use it as support. If the bulls get up here and stay up here for a little while, that is bull market territory and bull market territory on the whole bubble model, on the support lines, on the averages, everything. And the momentum would all be super bullish if it got up there and did that. But it's not bull market territory until you get clear up here. And it's not bear market territory until you chop and break down underneath this one. And so that's where we are right now, just in the middle of nowhere, just flopping around, maybe fun for day trading or something like that. Pretty hard to, to predict what's going on right now, because the whole economy is in shambles. Maybe it's improving a little bit. The stock market doesn't care, but it does care because it stopped going up. It's chopping around. But yeah, that's kind of the thing to look at. So I guess on the solvency outlook, we're getting companies starting to face bankruptcy, but they're sort of extending and deferring loans for everyone. Like the housing sector, they're deferring, and looks like they're going to come out with more money for individuals. So, I mean, we could see the kind of solvency crisis that looks like it's coming be delayed 2 months, 3 months, 4 months. I don't know how far they can keep pushing it out and delaying loans being paid. But I mean, if you get 6 months back on a loan, then you have to start paying on it. Like, you're screwed. Like, people are going to be immediately bankrupt or whatever. I mean, the Fed, well, like for people's mortgages, individual mortgages, like the Fed is buying those mortgage-backed securities. Like, that's who has your mortgage. The Fed just has it on their balance sheet. And so there's people like in California, there's tons of people just living in their house and not paying their mortgage. There's people that have been doing that for the last like 5 years and stuff like that. So I don't know if that's going to continue where like the whole country is just like staying in their house and not paying their mortgages and stuff like that. But, and then the companies are all not profitable, but they just keep giving them 0% loans and rolling them over and buying bonds. And so, I mean, we have like zombie houses, zombie companies, and it just keeps going. I don't know. But nobody, I don't know. It's going to be pretty crazy. The rest of this year is going to be really weird. But we'll see. We'll see what happens as solvency and bankruptcy starts becoming an issue. Because I mean, they can't bail everyone out. I mean, there's tons. That's why I keep looking at the Russell, the small cap, because those are a bunch of companies that aren't on the bailout list. And we've seen companies like Chesapeake and Hertz and stuff get in trouble already. But Ford's in trouble. They're bailing Ford out and buying the bonds and stuff like that. So, um, yeah, definitely have to see how that kind of affects the market in general. If we start getting more bankruptcies, and then are people going to keep buying the bankrupt stocks? Like that Hertz thing was ridiculous. But Hertz has come back down now. It did the stupid little bankruptcy bubble. And the SEC banned Hertz from issuing new shares, which was moral and just. That was good. So this is crazy. This is the craziest year ever. Oh yeah, I have I don't know. I don't know if it's ready yet. I have some like t-shirts and some swag and stuff. I'll put links down below for that stuff. I don't think it'll be ready for this video. But yeah, please hit the subscribe button. I'm getting close to 1,000 subscribers, and then I've got some t-shirts and stuff if you want to check it out. kind of some fun stuff for the Bulls and the Bears and Republican, Democrat, and Libertarian stuff, like all kinds of different stuff, no matter what your affiliations are. So I think that's about it right now. Um, Balance sheet is down again. Fed is not pumping. Congress is not pumping. They're just holding on to see what happens right now, it looks like, and that is generally not good for the stock market, um, but this is no normal stock market. This thing's insane. So we'll see what we get. That should be an interesting next week should be pretty interesting, and then yeah, the rest of this year is just gonna be nutty. So not investment advice, and happy trading.